Hello there. Welcome to iSectors second quarter 2024 market review video. My name is John Koch, iSectors Senior Investment Analyst, and I'm joined by the CEO and CIO of iSectors, Vern Sumnicht. We'll get into things right away. As everyone knows, equity market returns were very strong last quarter and have been for much of this year and last year as well. What's been driving this? We all know the answer. The largest 5 or so companies in the stock market. It's all we hear about, and you know the names. Microsoft, Nvidia, Apple, Amazon, Facebook, Google. In fact, the top 10 companies by market cap occupy almost 35% of the S&P 500 index, which is nearly an all-time high. Now, with the S&P 500 being extremely concentrated at the top, this has led to a self-fulfilling prophecy of sorts, with those top 10 stocks now being more expensive on a price-to-earnings basis than the rest of the index by far, as seen in the chart on the right, courtesy of JP Morgan. Almost 30 times current earnings of the top 10 names compared to 17.6 times for the rest of the index. Here's another chart showing more visual proof of how those large cap growth names have done compared to the rest of the market cap spectrum, evidenced by how far ahead the red line is here. That line is the Vanguard Growth ETF, which is a large cap growth ETF holding only large cap growth names. The rest of the ETFs listed here are all value and growth ETFs, ranging from large value to mid value, mid growth, small cap value, small cap growth. And you can see large cap growth just by far dominating everything. But what doesn't add up to us is that even with all this outperformance of those top 5 names powering equity indexes to all-time highs, this has persisted even despite the sort of unsettling situation currently facing the Federal Reserve and the U.S. economy. We have a few slides here showing the sort of conundrum that the Federal Reserve is in right now with regards to interest rates and the economy. Right now, this is the CPI index. We have inflation moving toward the Federal Reserve's 2% target, which you would think would be a good thing. They've held interest rates high for a little while, and it's perhaps doing what they wanted with regards to inflation. But at the same time, money supply growth is telling a different story. Here you have M2 in billions of dollars so far this year, steadily increasing. So with money supplies increasing, that's generally an inflationary indicator. Even though CPI is going down, that doesn't quite add up. And then with interest rates this high, unemployment has been slowly increasing so far in 2024, which is the labor market is one of the big things the Fed has been talking about. That would the labor market and unemployment increasing would sort of lead them towards interest rate cuts. But with the inflation story sort of in flux, that may not be a given at this point. With unemployment going up, GDP also trending downward, those two things tend to move together in that way. So we've kind of have a lot of mixed signals going on as far as the economy and what the Federal Reserve is going to do. It's hard to trust the outperformance I showed at the beginning continuing and persisting beyond this year, and obviously the last 5 years have been great for those pure equity indexes. But here at iSectors, we have some solutions where it may be a good time to pivot to more diversified allocations, which Vern is going to talk about now.
Thanks, John. So what do you do in an environment like this? I guess the same thing that you've probably been doing for the last few years, right? It's diversification. Although we think it's important that we include in that diversification some inflation protection. Okay, so in our more conservative models, you might be comfortable not doing too much inflation protection, but certainly as your clients get into more balanced portfolios, growth portfolios, you're going to want some inflation protection to get some growth out of your portfolio. At least we believe that's true. We also think that in the more aggressive portfolios, some crypto using a diversified portfolio Bitcoin and possibly some other equities like our crypto block model, precious metals, inflation protection. Our inflation protection model has a bit more diversified approach to uh, protecting for inflation. So it includes about 25% tips, and that helps to reduce the volatility. Commodities as well in there, in a more concentrated portfolio or more aggressive portfolio. Precious metals and crypto block are a little bit more aggressive approach to inflation protection, and also allowing you some nice growth. But those are some examples of ways we've suggested, ways that we use to help our clients diversify their portfolios in this more uncertain environment. Um, but there's many ways to blend our iSectors models. We'd be happy to help you and discuss those more specifically for particular clients if you wish. You're always welcome to give us a call, and we would try to work with you more specifically to develop a model. Thanks, John. Appreciate it. That was well done.
Absolutely. Thank you, Vern. Thanks everyone for watching. Have a great day.